This is a quick video regarding 3 different life insurance policies that are sold in today's market. There are a few different qualifying factors that set premium for life insurance policies. The first one is age. We're going to base this off of a 30-year-old person in this example. A 30-year-old individual has a lower insurance premium than a 31-year-old person, and a 31-year-old person has a lower premium than a 32-year-old person. So the older you get, the more expensive life insurance becomes. We know that the older you get, you're getting closer towards the end of life expectancy. The second one we speak about is health. We're talking about blood pressure, cholesterol, lifestyle, tobacco use, etc. And then lastly, we're talking about sex. Scientific data shows that typically women live about 3 years longer than a male would. So a male has higher premium costs than a female does on life insurance. The first policy that we're going to speak about is something called a term policy. Now, in this example, we're also going to base the death benefit off of a $500,000 policy. A term is actually a policy that is put in place for a specific period of time. And in this example, we're going to use a 30-year term. If the policyholder passes away during this 30-year term, the beneficiary is going to receive this $500,000 death benefit tax-free. This policy, again, lasts for 30 years. If the policy owner outlives the policy, so makes it through the 30 years, the policy expires and there is no more life insurance in place. One of the great things about a term policy is it's a relatively inexpensive insurance cost. It actually is the cheapest insurance product on the market for life insurance, but gives a large death benefit. One of the negatives to this product is once you outlive the term, you are now 60 years old and have no life insurance. So when we go to put another policy in place, we're looking at age and health. And at the age of 60, it's much more expensive to purchase life insurance. And also the health of an individual at the age of 60 is different than when they're at 30. Think of a term policy as renting an apartment. You rent the apartment for a specific period of time, and when that time is up, you move out. Again, the term is for an extended period of time. When you outlive that policy, the term is up, the policy has expired. The next policy that we're going to talk about is something called a return of premium policy. And this policy is very similar to a term policy, and that, again, it is for a specific period of time. This one we're going to say, again, in this example, is 30 years. If the policy owner passes away during the 30-year term, the beneficiary receives the $500,000 death benefit tax-free. If the policy owner outlives the policy, again, we're going through the process of, to get more life insurance, we're looking at age and health and going through the underwriting process again. Becomes very expensive at this point to put a new policy back in place. One of the great things about the return of premium is for every dollar that you put in and you outlive this policy, you will receive all of that money back tax-free. So think of it as leasing an apartment. Now you're going to pay a little bit more for that apartment than you would a standard policy, but after moving out of that apartment, you get all of that money that you put into the policy back. Both of these policies have a set death benefit that is put in place when you first purchase this policy. This never changes, it's always the same. The last policy that we speak about is something called a whole life policy or a permanent policy. One of the great things about a whole life policy is that the death benefit actually rises throughout the life of the policy, and that's because interest or dividends are paid into the policy and the death benefit rises. Another great thing about this policy is it accrues cash value. So what happens is there's typically about a 3-year waiting period, and then cash value starts to accrue. You can actually borrow this cash value at any time throughout the policy for anything that you want. So for instance, you want to purchase a new car, a new house, pay for tuition in college for a child, whatever it may be. There is interest that will have to be paid on the cash value that is borrowed. If you choose not to pay the cash value back, the insurance company at the time of death may or will subtract the cash value used plus interest against the actual death benefit to make the money back. The whole life policy, like we mentioned, is with you for your entire life. This policy is more expensive because, again, it's with you your entire life, and it also accrues cash value. The premium that you pay for this policy is set and will never rise throughout the life of this policy. Think of this more of like owning a home. So the longer you make payments on your home, the more equity that you've built in that home. Again, we go back to cash value. That's what we're talking about. So again, quickly, a term policy, just like renting an apartment, you're in for a certain period of time. When that lease is up, you move out of the apartment, you're done. When the term is up on the policy, there's no more life insurance. It's over, it's expired. The return of premium, very similar concept. You're leasing the apartment for more money, but at the end, when you move out of the apartment, you get all the money back. Same thing. It's a specific period of time that you have the policy for. If you outlive the policy, you get all the money that you put in back tax-free. If you pass away, the death benefit is paid to the beneficiary. And then lastly, the whole life policy that's with you your entire life. It is a permanent policy that has an increased death benefit and has cash value. So like owning a home, the longer you make the payments on the home, the more equity that is built in the home.